Hello, I'm Regina McCann-Hess, President of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about required minimum distributions. And taking required minimum distributions from your retirement savings can sometimes be tricky if you don't know all the rules. So we're going to talk about that. We're going to talk about 10 things that you should know about required minimum distributions, and we're going to call it RMDs for short. That's the lingo these days, so that's what we're going to do. Number one, we're going to tap into your savings, even if you prefer not to. So, in other words, you've been saving this money for years and years, probably decades. And some of that money has never been taxed, and maybe all of it has never been taxed. But when you get to a certain age, Uncle Sam says, I want my piece of the pie. So that's when you get to that point, and that's when you have to start taking it out. And you know why? It's because you can't avoid paying taxes on that indefinitely. So you're going to eventually need to start withdrawing from those accounts in the form of the required minimum distributions, or RMDs for short. The IRS will then tax those distributions as ordinary income. So that's them getting their piece of the pie. The second thing that you need to know is that your RMD threshold depends on your age. And the age rules for RMDs have actually been a very much moving target for the past several years. For many years, they stayed the same. But then in 2019, Congress changed the long-standing age for RMDs, which it was 70 and a half. They moved it to age 72. Then in 2022, a law raised the ages again from 72 to 73 at that point. And then they also put a provision in there for it to change again in 2033. The average, the age threshold will rise to age 75. So by the time you're 75, you will have to start taking distributions. A lot of people right now, though, they turn 73, they have to start taking distributions now. But in the future, that'll raise to 75. Okay, third thing you need to know is that, hey, if you're having a birthday this year and you're turning 73, your clock is ticking. So now you want to talk to your financial professional or your accountant about taking your required minimum distribution. This is the year that it starts for you. So talk to somebody about that. Point number 4, are you still working? You might actually be able to delay some of your required minimum distributions. So even if you're over 73 and you're working, your 401k or your 403b account more than likely could remain shielded from RMDs until April 1st of the year after you retire. Now, obviously, you want to check with your retirement plan administrator to determine if the plan allows you to delay your required minimum distributions, because not all of them do. There is no exemption. However, if you own at least 5% of the business, you're not allowed to delay the RMD. So keep that in mind. Okay, point number 5, IRAs, Roth IRAs. What's the difference? Well, with a traditional IRA, any regular contributions or investment gains are shielded from taxes until you take money out, or in our case, we're talking about RMDs, until you're forced to take money out. Now, Roth IRAs are similar in the sense that, the money grows tax deferred, but there are 2 critical differences. Roth IRA contributions are made with after-tax dollars, so you're not taxed on withdrawals from the Roth, and your required minimum distributions only apply to beneficiaries. So you can be 73, 75, 80. You do not have to take a certain dollar amount out of your Roth. You can, and at that point, those withdrawals are not taxed. Now, assuming you have to follow the rules and all that fun stuff, but for the most part, that's the rule on that. Okay, point number 6, other account types subject to required minimum distributions. So retirement savings accounts subject to RMD rules include your IRAs, that's your traditional IRA, your SEP plan, your simple plan, 401ks, 403bs. There's also something called a 457 plan out there. So those are important to know. Now, in 2024, Roth 401ks, Roth 403bs, and Roth 457b plan accounts are no longer subject to RMDs. So that's a huge thing. You do not have to take money out of your Roth if you hit that magic age. So that's good. Okay, point number 7, staying out of the penalty box. So if you forget to take your required minimum distribution, you can potentially have a 25% penalty for not taking that out. But there are a few ways to avoid that. And the first one would be to, take the distribution and then file a IRS form 5329 requesting a waiver and explaining why you missed the deadline. If the IRS decides not to allow that waiver, you would have to pay a 25% penalty. But if they do determine that, you had a valid reason, that 25% penalty may be reduced to 10% if you correct that shortfall within a 2-year window. Or maybe it could be waived entirely if you miss the RMD due to some kind of error, but it's definitely worth at least submitting that form to see if there's a potential for avoiding the penalty. Okay, point number 8, we want to sharpen your pencil and do some math. Okay, the minimum amount that you should withdraw each year is calculated by dividing your account balance at the end of the previous year, December 31st, by the distribution period based on your age, which is also found in the tax table published by the IRS. Now, there's an easier way to do this. You could talk to your tax professional, you could talk to your financial professional, but a lot of times it's actually on your statements. You can go online and pull it up right up on your statement, or it might be somewhere else on the website for your financial institution, because the financial institutions do normally calculate this for you. But if you want to double check, it's actually a pretty easy calculation. You just got to go to the IRS website to figure out which table to use, and then get your December year-end value, and then you can do it. Okay, point number 9, multiple accounts. Think about aggregating. So if you have like several different IRAs or 401ks, you have obviously accounts in more than one place. You need to determine the RMD for each of those accounts separately. So if you have 5 accounts, you want to do the calculation 5 times. Now, there are some account types, including traditional IRAs, rollover IRAs, SEPs, and simples, that can be aggregated. So you can add up the total RMD due for those accounts held at different spots or different institutions, but you can withdraw it from one account. So I've run across that where a client has an IRA here, an IRA somewhere else. We calculate the RMD from the other account, we calculate the RMD from here, and we just take it from one of the accounts. So you can do that. You may just, again, talk to your financial professional before you make the decision on that. Now, if you own the thing that you want to keep in mind here is that if you own more than one 401k account, you're not actually allowed to aggregate them. So you do have to take the RMD out of each of the 401k plans if you still have the money in a 401k. Okay, 10th thing on our list is actually a win-win idea. So it's a charitable contribution from your retirement plan. So you can reduce your taxable income while qualifying towards your RMD by directing up to $100,000 to a 501c3 charitable organization of your choice. So your retirement account provider, not you, must issue the qualified charitable distribution on your behalf by December 31st for the tax year that you're trying to do that. Now, we call them QCDs for short. That's a qualified charitable distribution. And that can be advantageous for high earners concerned about being bumped into a higher tax bracket or being forced to pay higher income adjusted Medicare premiums. And these are great ways to, give money to charity by also, keeping yourself in your current tax bracket, because the money goes directly from the retirement account directly to the charity. It doesn't touch your hands, so you don't have to pay taxes on that money. But do know that you don't also get a tax deduction for it because you're bypassing paying the taxes on it. So that is fair game, right? If you're getting to give the charity money without having to pay taxes on the distribution, I think it sounds like a win-win to me. But there's paperwork, of course, to do that. You can work with your financial advisor to do that, but the money goes directly from the retirement account to the charity of your choice, and it really makes a lot of people happy. So our call to action today is, talk to your financial professional about your required minimum distribution if you're that age, or even if you're approaching that age. I have client conversations with my clients a couple years ahead of their required minimum distribution age. And that's so that we can start planning like, hey, what do we want to do? Is it possible for us to do the qualified charitable distribution, or do you need that required minimum distribution to help you with your cash flow expenses? And we include the accountants in those conversations because, we want to partner with them and make sure that we're not treading on toes and that we're keeping everybody in the loop, and that just benefits the client. So definitely talk to your financial advisor and your tax professional about how to handle your required minimum distributions and possibly ways to use those qualified charitable distributions as part of your strategy. And with that, I want to thank you for joining me. Again, I'm Regina McCann-Hess. I'm president of Forge Wealth Management, and our website is forgewealth.com. You can follow me on Facebook at Forge Wealth, on Instagram at Forge Wealth Management, and LinkedIn, I'm Regina McCann-Hess. Go make it a great day.